Well, welcome everyone. I want to be respectful of everyone's time. And Michael, appreciate you being here, and excited to just kind of kick it off. I think 2026 should be an exciting year, and I guess I think a lot of the people on the call probably know you, but not everyone does. So if you wouldn't mind just giving background about yourself and
Sure.
just kind of how you got into this industry and go from there.
Yeah, I'm Michael Becker, based in Dallas. Lived here my entire life and kind of got into the industry through the banking side. So I was a long time commercial real estate lender and worked for some regional banks and have a kind of variety of a lending background in the kind of all the major asset classes of commercial real estate. And then 2008 happened and kind of did problem loan workout. My regional bank got bought by Wells Fargo. So I got to Wells Fargo at year end '08 and then kind of did problem loan workout for about 20 months, give or take. And that was pretty tough, pretty tough, but valuable learning experience. And then started loaning money again in 20 late 2010, and then started buying my own kind of my own investment real estate starting in 2011. So started like a lot of people, some smaller kind of single family homes and rent houses, stuff like that. And then realized it wasn't very scalable. So ended up, transitioning, met my now partner, Sean. I made a loan to one of his clients. He was working for a broker out of Los Angeles, and made a loan to one of their clients. That's kind of how we met. So then we ended up buying our first apartment deal in 2013, 120 unit deal called Bay Island Apartments in Garland, Texas, which is currently or recently was on the market again. Um, and since then, we've probably done about 20,000 units. We own about 9,000 units today. Started just, workforce housing, 60s, 70s, value add, and kind of took the opportunity of the last cycle to kind of sell old and bought new as the cap rates kind of compressed. And so most of what we own today is kind of, 8A minus, 2000s or younger from like a vintage standpoint. However, last November, 2 months ago, basically we bought a 80s deal. So we're kind of selectively starting to dip our toe back into kind of the 80s vintage. I'm not quite super duper excited about the 70s, but we might still go to there. So starting to kind of have a pretty wide buy box. Dustin's been pretty tight from a vintage and location standpoint, and we're starting to get a little bit wider on the vintage. And as the market dislocation has gotten a little bit deeper, and people are starting to kind of recognize today's values where they hadn't in the recent years. So starting to get kind of excited to kind of go back in time, buy some older stuff, and we own in three of the four majors in Texas, own Dallas, Austin, and San Antonio, and let you guys buy all the deals in Houston. So that's kind of where we're at.
There you go. Okay. Yeah, appreciate that. So you kind of I guess yeah, for a lot of I don't know, probably no one really here was buying 2008, 2009, at least on the call, or not very many. But I know you were kind of on the banking side of things. Can you kind of talk about some differences maybe
Yeah.
between '08, '09 and versus now, and a lot of foreclosures coming out. I think I don't know if this is accurate. I'd heard from a broker they were thinking DFW peak foreclosures was kind of midsummer sometime. I don't know if you've heard any other dates, anything like that, but would love to get your thoughts on
Yeah,
that.
second part first. I haven't heard much about that, but that would make sense. Probably Q2, Q3, somewhere in that vicinity would probably make sense. It seems like some of the differences is, that was way worse feeling back then. Obviously I didn't own any real estate and I had a paycheck, so that was a little different for me personally. And I was, 30 years old in 2008. So very different moment in my life. But yeah, that was there was no liquidity, and that was like the light switch got turned off overnight. And one day it just was off, and then it took forever to come back on. So the liquidity wasn't there. There was no equity, there was no debt, right? I mean, so it was a tough scene where this time there's been plenty of liquidity. There's equity out there, maybe not as abundant equity. Equities have been a little tougher, but there's been plenty of debt this entire last 3 years. You just don't like the price or the terms. Back then there was no debt, so no matter what price or terms were, it was tough. So people had to, whatever limited debt was pretty tough. And then a lot of people had to buy these deals all cash. And so that's probably the difference. And then back then, obviously there was a lot of home building, overbuilding on the single family side, and all our tenants could, fog a mirror, go get a mortgage. And so that was very different. There's a big, large overhang of single family supply where we don't have that today. And the single family housing market is so expensive relative. Your rent to buy is so much better from a value perspective for our tenants, where that was not the case back 17 years ago, I guess, whatever it is now. So those are some differences. So this is why this feels terrible. That was really painful and a little bit quicker. This is less painful, but a little bit longer, and it seems like we're probably, I think the values have kind of bottomed out, and I think it's just everyone's finally recognizing that, okay, this is the reality. I don't have any more rope. So, if I don't have enough room to go get 2, 3, 4 years down the road, then, am I going to be any better off, especially like in the workforce housing? So the workforce housing is finally kind of starting to bottom. It feels like Class A has bottomed, and we're off the bottom in general, and Dallas Fort Worth, let's say.
Awesome. So what, I guess kind of focusing on DFW here, what sort of deals are you going after, looking at? What do you feel is attractive for you right now?
Yeah. So what's kind of most interesting to me in Dallas Fort Worth tends to skew a little bit older. Like I said, my read of the market is that we're off the bottom of Class A. So, you can't go buy a merchant built deal and steal it for, significant discount to replacement cost. Even like the far northern suburbs of, Salina, Prosper, where there's been kind of a tremendous surge in supply, where there was like no supply 10 years ago. Now there's a ton of apartments up there, and it's pretty bloody from a concession and rental rate standpoint. Even those deals aren't really trading at, substantial discounts, so would make it attractive to me. So starting to kind of look a little bit older. This last year, 25, we bought 4 deals. All 4 deals were in Dallas Fort Worth. So we bought at the very beginning of the year. It was really a 24 deal that closed in the beginning of 25. We bought a 416 unit deal, 2017 vintage in Aubrey. So off at 380. Kind of a little bit, for those who aren't familiar, it's kind of a little bit of no man's land. You're kind of halfway between Denton and kind of Prosper, Frisco. And 380's been a war zone from construction and expansion. So it's been real difficult scene. And the thesis was that, we buy it, the supplies going to dwindle, and the road construction will be done towards the end of 2025. That's kind of what's played out. So construction's done, traffic pattern is much easier, supplies basically all stabilized. So now we're hopeful that we'll kind of get a big push. I think we were like in the 158 a door range. They're pretty big units, like almost 1,000 foot average. So
Oh, wow.
four-story elevator served surface park deal. So felt that was a pretty good, pretty attractive price. Then we bought a two-phase deal, 2010, 2016 for phase one, phase two on a HUD loan assumption in Louisville, called Crest Manor. So we bought that for about 180 a door. Pretty big units, also about 1,000. And we had about 57 levered, and the blended rate's like 3.8, I think,
Oh, wow.
blended rate on a 35-year amortization. So it's a value within the mortgage. So probably, without the mortgage, would have been paid a little less. Mom and pop owner operator, actually the original developer, original guy who developed it, still owned it and self-managed. And it was there's a lot of nuance with that deal. But so that was the second deal we bought. Then right at the end of the year, we bought a 1984 vintage deal, 316 units, called Haven at Chisholm Trail. And then we bought back a deal. So we owned a deal in Denton called Canopy at South Lakes. We bought it. It was a COVID deal, so very into 2020, closed at the very beginning of 21, kind of before the big run up in rents and rates and stuff like that. And then we sold it at the very beginning of 2023. We in the interim we refinanced it with a Fannie Mae loan, a floating Fannie Mae loan. The guy I sold it to, he assumed my mortgage. About 3 years later, we just closed right before the end of the year, bought it back. The guy unfortunately died. The sponsor died. Deal was an absolute mess, about 45% occupied. So we
Oh,
ended up
wow.
assuming it back with only a couple $1 million down, plus reserves and capex. And so, we had more equity in it, but it's only about a couple $1 million over the mortgage balance. So pretty compelling story. So we did 2 equity raises towards the end of the year on those deals to kind of have some recent experience raising capital.
Okay. Yeah. I guess just kind of touching on that, I guess how have equity raises, been for you? I know we did one earlier, kind of in the fall. It wasn't, no one's dropping money in our lap, but it wasn't terrible. So, yeah, I'd love to hear your thoughts on your equity raises.
Yeah, so both these deals that went surprisingly well. They were pretty small relative to what we needed. The amount of like kind of outside capital for each was like 6 to 6.5 million each, I think. So for when for perspective, when everything was just ripping and raging in 21, we could raise 30 to 35 million in a month. So obviously this is substantially lower than that. But it was a little fearful going into it. Like, I figured it was small enough we'd figure it out. But it's been, it's tough. Like nothing's
Yeah.
easy now. So we were like kind of fearful of it. But I got to the kitchen sink approach to both, threw it out there, and it went, really well. The first one took about 2 weeks to get all paperwork committed and wires in. Then we had a few weeks kind of lead up to it where we're kind of marketing the deal. But when we went live, it was about 2 weeks. The next deal was 4 days.
Oh, wow.
What some of my takeaways was, it was helpful that it was in the fourth quarter.
Hmm.
So towards the end of the year, and it's helpful now that the but 100% bonus appreciation is back. So, we kind of towards the end of the year, you invest in this deal. Both of these were basically 100% appreciation. So you put $100,000 in, you get $100,000 tax write-off, and you get that K1 in a month later or 2 months later or whatever. So that is helpful. You do this in Q1, it's a little less helpful because people aren't quite thinking as much about taxes. So that certainly was a wind in my sail. Everyone I think is looking for a story. So, the first deal, ladies deal was a guy bought it in 21, was in it for about 45 million. We bought it for like 31 million. He's basically losing all his money. He cleared just a hair over his debt basis and his payables. And he moved rents $200 and still lost all his money. And the property was pretty much fully renovated. And then he accumulated a little deferred maintenance over the last year or so when he kind of ran out of money. But it's kind of a pretty stable deal, and I think we were like 95 a door, and he was in it for like 135 a door. So our exit price is below his all-in basis. So that was compelling. We had a 5-year fixed rate at like 480 something, 484 maybe, something
Hmm.
like that. And then the second deal was even more compelling. I mean, like, not to be, morbid, but the guy we sold it to actually unfortunately took his own life. Real sad story.
Oh, wow.
And then he self-managed and he didn't really know what he was doing to start with. And then so basically no one was there for 4 months overseeing the property before another member of the group took it over and kind of
Hmm.
somewhat stabilized it a little bit, but they were not really engaged super strong in the deal. So as soon as people like, as crazy as it sounds, as soon as people realized what happened, I was like, oh, where can I wire my money? It was just a great
Yeah.
story, right? And
Yeah.
we had owned it before. So, basically we're buying it back for basically the price we originally bought it for and had a real, high levered loan. And all we had to do was show up and pay attention and we'd, get back to 90% occupied and then our capital plan and we'll take it up from there. But people really like the story. So if you have a story, which is pretty much every deal, especially in the workforce housing deal, those make sense. If it's a core plus play and prosper, those don't attract as much interest right now. I think if we go to Austin and the guy's losing all his money and that's more of a compelling story if those start trading here in 2026.
Gotcha.
Yeah, we've seen similar instances on our end where that story is just super compelling right now. So I'd be curious too, for 2026, how do you anticipate raising capital is going to go? I know you've obviously been pretty active, especially last year. So what do you anticipate this year is going to look like for raising capital?
Yeah, I think it starts getting a little bit easier, I mean, like the struggle that you guys have and that we have, and probably, Sierra and Cats on here, people that have been around the block a minute, is you had some properties, you made a bajillion dollars, we made more money than we deserve to make. And the big run up, and then those that are in our deals or other people's deals, distributions are off in a lot of cases, and having to refinance and the refinance term, they need some cash in to refi. And so a lot of people have invested in the kind of allocated and a lot of those deals, we haven't lost anything, but you know, people probably invest in deals, they lost 100% of their money or 90% of their money. And so they're kind of gun shy. So if you've been around the block a while, some of those people are a little bit harder to, get to invest and commit where, you're having to kind of get the new blood in. And so, constantly keep marketing and getting new people in. And then we have a lot of people that, the repeat investors that have been with us and had the successes and gone full cycle. They're obviously much more bullish. So, just trying to identify that. But that I've done this so many times now. Hey, you just never know. Like, you never know where it's going to come from exactly. You think you do, but then like someone comes out of left field and they have just a situation where they had a liquidity event because they sold their company or, whatever happened, got an inheritance or, whatever happened and they're ready to go and you hit them at the right moment at the right time and they have a tax need and you got a big depreciation and they believe the story and they're ready to kind of go. So from the syndication standpoint, that's what we're doing. We've done the first two deals we did large joint ventures with like a single source equity check. And I hated every minute of it, and I'm going to NMHC in 2 weeks and I'm going to take 20 meetings with guys like that. And hopefully, they'll come through. Those guys have been pretty difficult to actually come through and follow through and actually fund and commit to these deals. A lot of people say they want this stuff, but then they find reasons for, everyone's just a little unsure, and those guys just aren't committing capital, as easily. I think what they're waiting for is they want to see that the bottom's in, the rents are up, and that's sustainable, and they feel like, they know where, forward rents will be higher than kind of, and that's a much more of a surety. So I think that's what really is causing hesitation for them to act in large scale. But I think as the year kind of goes on, those guys are going to rush in. I think you see cap rates kind of compress on the top end of the market, and then the bottom end of the market is going to be, a little bit all over the place, right? I mean, these foreclosures, distress deals, there's going to be accretive, high leverage financing from the bank, which you've seen some deals clear that way at like 100% financing. They just got to bring in that money for working capital and capex. We haven't done that. And that's not really something I'm overly interested in. Um, or they're going to clear and they get new debt and what does that look like, and that those values are obviously going to be substantially below where they were a few years ago, so it's going to be kind of a little choppy mode, but I think that's where the opportunity lies, and trying to pick one or two of those off this calendar year and that kind of the 80 space that is a little better located, and like HEB or Carrollton or some of the better suburban markets that aren't a complete dumpster fire from a physical operational standpoint, and kind of come in with a 5-year fixed rate agency loan. That's kind of what I think is the most interesting for me.
Gotcha. Okay. Do you, if you want, if you can kind of touch on Austin and in San Antonio, are you looking there right now? Are you kind of staying away? I mean, we were talking, before the call, Austin's been a tough market for quite some time. So yeah, if you
Yeah.
want to kind of touch on those two.
Yeah, no, I think from an operational standpoint, Austin's tough would be an understatement. I mean, it's been very very challenging. Concessions, lower rents, everything's tough down there and has been for a couple of years. But it feels like probably values have kind of bottomed, and people you haven't seen many transactions because there hasn't been very many sellers. So the volume is like, next to nothing. The brokers are starving down there. I mean, they're just not, there's just no transactional volume. So you got to think the volume picks up this year. And more and more people just kind of into the ropes they have to clear. But, compared to, let's say, Houston or Dallas or San Antonio, Austin doesn't have very much 70s and 80s stock as a percentage. So it's a much younger apartment stock relative to the overall percentage. So, most of the deals are kind of, 2000s and newer, or honestly, really kind of 2010 and newer is most of what Austin is, where Dallas Fort Worth, probably a third of the apartment stock was built in the 80s. And Houston, I think, is kind of similar.
Mhm.
So, it's just all kind of newer stuff. And so, everything that's going to trade will have to trade to below replacement cost and, maybe even below the seller's basis to really kind of clear. So those that don't have to sell, you're not willingly going to market and trying to sell anything right now. So that'll start picking up, and then once you kind of see those values kind of trade and the market kind of resets, and I think you'll see the volume kind of pick up as we go throughout the year. That's what I think is going to happen in Dallas workforce housing space, was where there's been very limited transactions. And here in the fourth quarter, you've seen several deals, including the one I bought. You kind of reset the basis. There's several marks on the scoreboard of like, this 80s deal is worth 100 a door in the submarket, and then all the others that are holding out for 115 have to kind of either, come to that reality now. And I think that's what kind of clears the market. So hopefully we see that in Austin. And I think it'll be a pretty violent bounce back. Rents should start growing, and whenever they stop falling, I think they kind of bounce pretty hard because the rents are down, 25-30%, especially effective rents when you include concessions. So, they're off substantially. So I think those have quite a bit of room to recover in a pretty short order. And then I think, the capital will start flooding in because the growth and the absorption have been pretty strong. There's the demand just has overwhelmed, or the supply has overwhelmed the demand. And the San Antonio is doing better in the Class A, which is what I own. So we own one A minus deal and four Class A deals down there. And that's the occupancy's firmed up, the rents have firmed up, concessions are falling. I think we see rent growth this year. I think it's really kind of firmed up. And if you look at a pipeline, there is essentially no new supply in San Antonio. The math just doesn't make any sense. So I think the supply pipeline is going to be off for, you know, 2 years, and then they start building, and then it's another 2 years before they deliver. And I think it's going to be a fraction of what it is. So I think they're going to deliver 3,000 units in the entire MSA with 250,000 market rate apartment units or something like that. So it'll be next to nothing will be delivered in 2026, and 27, 28 should also be pretty low supply years. So I'm pretty optimistic. There, the workforce housing, which we do not play in, but I've kind of followed just from the sidelines. It's tough. Like, I saw a 1970s deal, 1970 deal, flat roof, and, marginal submarket to be optimistic. And it came out John Krebs at 38 a door. And I was like, oh shit, it's 38 a door. I was like,
Wow.
I didn't look at the financials or anything like that. I was like, geez. So that's, in the marketplace.
Yeah. Holy cow. That's cheap. Yeah, I think just to touch on Austin a little bit, I think I saw out I don't know Austin super well just from a rent perspective, but I think I saw they are pre-COVID rents. Rents have fallen so much they're pre-COVID.
2019, 2018 value rent
Yeah,
levels. Yeah.
which is crazy.
Yeah. That's right. Especially with concessions thrown in. Yeah.
Yeah. Yeah. Gotcha. How just for I guess just kind of looking, into this year and all that. I know we have NMHC here in a few weeks and all that, but you kind of see deal flow picking up, or what do what's that, feels everything we're seeing sounds like you're, basically kind of saying the same thing that we have a buying window, buying opportunity. How long do you think that lasts? And just kind of what do you think, 2026 might look like?
Yeah. So I think kind of your Class A and even your A minus stuff in Dallas Fort Worth, I think we're off the bottom. I think we're on the way up. I think there's much more confidence in that space. And I think as we go throughout the year, there'll be, more and more demand for it. There'll be a surge of kind of February listings, let's call it, kind of come in NMHC or just after NMHC, just talking with the brokers. I know IPA's got a whole list of deals they're about to bring out in the not too distant future, for example. And JLL's got a handful of deals, and CB's just brought a few deals out. So there's going to be quite a few listings on the Class A. And then talking to all the guys in the workforce space, they all have a bunch of BOVs, and there's a handful of listings, and it's kind of like go time, right? I just think it's gonna be very disparate and choppy in the workforce. So I think the bottom's in price, but the bottom hasn't really like been traded a whole bunch. I think there've been a couple
Yeah.
markers that are traded, and those where the new markers are going to kind of trade at, kind of trade off of. So I think it's, if you have a clean, stable deal and it's an 80s deal and not a war zone, you're kind of 6.5 cap. If it's a real distress deal, it's a per pound play. And it's kind of whatever, you probably got to get to yield on cost of like a 7, maybe north of a 7 to your purchase price and capex, kind of year 2, year 3, kind of yield on cost in the mid sevens probably. And you got to back into that, right? So whatever that's going to be, that's probably where these per pound deals trade. And then, obviously the 60s deals with aluminum wiring and chillers and the hood and terrible characteristics. I mean, it's probably yield on cost probably has to be, 9 to 10. So, if you gotta buy it for 40 a door to put 20 a door in it to be at 60 to then get to, a pro forma 10 cap, something like that, right? I mean, that's probably where these deals actually clear at if they clear, and the bigger they are, the tougher it is. So, I think for us, with our ability to raise capital and the track record and in the market, these 250 to 300 unit plus Class B marketed deals that go out at a price that kind of miss and then kind of miss again, and then we kind of hang around the hoop and get the like, well, I could take a flyer on some guy no one knows or sell it to you for a little less than that. I think that's probably, the play. I think these off-market deals, it's just like a mixed bag right now. I mean, everything has aspirational pricing and they need this number and one of the things I've been saying for about a year is like the market doesn't care what you need. The market is the market, right? So just because you need a number doesn't mean you're going to get that number. And it's just a big time waste. So, if the brokers are saying the seller needs this number, there's just not ready, so we don't spend any time on it. So we're just
Yeah.
really sensitive on screening on the front end, the situation, what's the debt basis, is this actually probable to clear? Am I going to go burn 20 hours on this deal and they're never going to sell it no matter what I do? So those are just
Yep.
some stuff that we're kind of, sensitive to today. And then Austin, I think you'd go buy Class A. If we don't buy a deal in Austin this year, I'm disappointed. We didn't buy a deal this last 2 years in Austin, so I really need to figure it out. I think now's a great time. It's really hard because nothing's going to pencil,
Yeah.
but groups like us can move a little ahead of the larger institutions. So hopefully we buy a deal in Austin. The San Antonio, if I could buy a brand new Class A significantly below replacement cost, I think that's a good play.
Yeah. Yeah. Gotcha. I guess switching gears just a little bit, what are you seeing on kind of insurance and the property tax side across your portfolio?
Finally getting some pretty big wins. Insurance last year was down. In North Texas, I think high teens on a percentage basis, and then I'm hearing our renewals in May 15th, so I'll know more on May 15th. But I'm hearing I don't know if we get double digit decline, but high single digits to maybe low double digits decline. So certainly stabilize. So I feel pretty good about that. So I expect a kind of further declination on taxes. Finally starting to get some pretty good wins. We're still litigating a handful of 24s. All over 25s are not settled, or maybe one is settled out of 30 some assets.
Hmm.
So we're kind of, we've been, having in Texas, for those that aren't aware, you have two ways to protest your properties or two approaches. One is kind of equal and uniformed, and one's a market value. So you can say, hey, you assess me above what the market value is, and that's been a difficult case the last few years because the market values have been going up. I think in 26, that's probably going to be the approach we take, where a lot of the other ones are having the last couple of years or last decade really, it's all been the equal and uniform approach, and you really got to be the strategy's always been you want to be the last guy to settle, so all your comps settle before you, and they're at a lower value than what you're assessed at, and that's not equal and uniform, so you can argue that that should be lower to be kind of in line with my comps that the county has. So those are what we kind of getting through for 24, and 25 is probably a jump ball if we argue market or eagle and uniform kind of deal by deal. But 26, I think we get noticed in early April. I think we're probably just going to order appraisals. We had a big meeting on this last week and another one yesterday. And I think we're just going to probably order appraisals on the bulk of them, just a market appraisal, and say as of January 1st, 2026, this thing is worth far less, and probably take that into the appraisal review board and show them an appraisal. So I think we're going to spend $4,000 in property on appraisal and go in with that approach. So probably not 100% uniform, but probably the majority will take that approach. I think that's likely to be the best strategy going to 2026. At least that's kind of what we're thinking right now.
Awesome.
Yeah, makes a lot of sense. I'm curious, Michael, you touched on this a little bit too, that it's competitive, right? You know, there's a lot of deals that have fallen out of contract that get retraded really over the last few years. It's just been tough to get deals to the finish line. So, you know, for all those people trying to enter the market, maybe they're new to this space, you know, what would you recommend for somebody that's getting started right now in this environment?
Well, yes, it's a great time. I mean, from the standpoint that yeah, it's always competitive, right? Especially in a big market like Dallas or Houston or something. There's a a ton of groups that are interested in buying, up and down spectrum of multifamily. And you start out, I mean, it's an unfair business, guys like Dustin and Hayden that have done, dozens of deals, they have a unfair advantage above someone trying to do their first deal. So, it's about like positioning themselves, having a team. Most people kind of have a co-sponsor or experienced management company, or what do you bring to the table? Do I have money in the bank? Can I qualify? Because the broker is going to want to know, can you get the deal done? It's kind of a pass or fail business. Either you can do it or you cannot do it. You need to convey to the broker to then sell the seller that this group has the probability of closing this deal. So, where's your equity? Where's your debt? How are you going to manage it? What are your terms in the deal? Are you, savvy enough? Are you, making some very rookie mistakes? They, just the way you speak to them, they realize you don't know what the hell you're talking about. So, all those things kind of come together. So getting a co-sponsor or, teaming up with somebody that has some experience or a management company or just being, if you're really rich, that certainly helps. But say relative to say 2021 when the market's absolutely ripping, the new groups had very limited chance without just, dramatically overpaying and posting a bunch of hard earnest money. You have, it's a very disparate playing field, and if you're $100,000 on top of a $10 million deal and your profile is not as strong, some sellers might need that $100,000. They might take a flyer on you, and you might get awarded a deal a little bit easier than you would have, say, 4 or 5 years ago when the market was absolutely ripping. So, you have the brokers will give you a little bit more attention today than they would have before, because all the guys that were buying in 21, 22, a lot of them are, going out of business, if not already out of business. So they're kind of the market's resetting and we're getting a whole new crop in. So it's a really good perspective, really good moment from that perspective to kind of start trying. And you don't have various issues you're having to kind of work through on your existing portfolio. So your time and mind share is, more optimistic, and you can focus on just new business or having to deal with the sins of your past.
Gotcha. Well, I'd like to kind of touch a little bit more on, capital raising and all that. Is there anything that you guys have done? Have you kind of, capital raising's got more challenging and all that. Is there anything that you guys have kind of changed up, to kind of respond to that difficulty and all that? Or are you guys taking a more hands-on approach, or a lot more calls, or what does that kind of look like for you guys?
These last two deals went surprisingly well, so I was bullish. Obviously come from a perspective we've raised, I don't even know how much equity, over $500 million. I don't know, something like that in equity has been a considerable amount of money we've raised over the years, and we've returned a considerable amount of money. So, obviously, uh, that's helpful,
Yeah,
in the
right.
process. But and then the amount of money we just raised was relatively small compared to, historical when the market was ripping. So those two caveats. But I think we've, you know, not done any half measures. It's all been full measures, like, so we go into an equity raise. It's like we're preparing for a battle, like it's going to be the toughest thing we've ever done, and we're not going to hold anything back. So we start with like a big push. We go as wide as we can. And then depending on the initial response, we then like either say, okay, we're good, or we throttle back. So the metric I always have used, Dustin, was like, if I need to go raise $6 million, right? If I go send an email to my list and say, hey, if you're interested, click on this button, fill this form out, kind of give me a soft commitment with the amount you're thinking. If that number is double what I need, so if I get 12 million in kind of soft interest, my 6 million raise goes pretty quick. I don't have to do a whole lot. There's enough kind of gravity where people like will take action quick enough, and then it'll kind of go. Then as 6 million, you get the first 4 million of paperwork, you start telling the rest of the people, hey, you're about to miss out on it, and then kind of goes kind of quick. Where if I need 6 million, I get 8 million interest. I'm like, oh shit, I gotta like start working this, So I'll have to kind of like lean in and get a little bit more, proactive about who I reach out to and, stay on top of people and just kind of really work it a little bit more. But I think it's like you guys are a good example. I do, co-host podcast with Paul Peoples, Little Capital Podcast. We've been doing that for I think a decade or maybe even longer at this point. We're not quite as regular as I would like to be, but it's hard to kind of fit that in with everything. But we have this podcast and we've been doing it for a long time, and I get a lot of people off of that. I used to be a little bit more diligent with going to events and speaking and stuff, and I haven't been as religious about doing that since COVID. It's just kind of the way that's been. But going to meetups or doing that or having a platform, I do a quarterly newsletter. I get a lot of people that read that, so I get a lot of kind of comments and feedback off a newsletter, and it's a real pain in the butt to do. It takes a lot of time, but like I have to do it no matter what because it's just like something I committed to, and people like to kind of understand my perspective, and it's a way for me to kind of communicate my current view of the market. And it's always the market's always changing, and my perspective of the market's always changing. So a quarterly basis kind of it doesn't dramatically change, but kind of incrementally improves or declines or whatever. So having a source where you can have people, no one's going to give you money if they don't know who you are or what you do. So having some, I find it's easier to be a magnet and have people drawn to me versus me having to go seek out and find people. So having a platform of some form or fashion, like your webinar is a good example. Your meetup's a good example of that. You guys do marketing emails, just kind of using what I know of you guys. That's probably where you get the majority of your investors is through one of their a webinar like this, email you send out, or one of your meetups. I'm assuming, and or a referral off somebody you met through one of those sources. So that's a big part of it. So just continuing to focus on that, stay consistent. It's hard because you get busy with life and work and other things to stay consistent. But if you can stay consistent with that, if you're starting out, you need to find your version of that. Who do you know? What's interested? How do I educate them on this platform, on the multifamily space? What I'm going to do? How am I not going to lose all their money? And why should they give me money? And things like that. Those are the things that you need to kind of focus on. And it starts small, then kind of compounds. We have 4,500 people in our database or something like that. And, we had 40 people in our database or whatever, and just kind of, it just is exponential. And, we did 2,200 K1s this last tax season or something like that. So just kind of, kind of grows and these people always change. And like, I'm always surprised. Like someone I for sure is going to invest in this deal. They invested in the last 5 deals. They don't invest. And then someone hadn't
Right.
invested in a deal in 5 years, come out of the woodwork and give you $500,000. Like, I'm just constantly surprised, right? Like
Yeah.
you just never know. So just like
Yeah.
staying on top, being consistent, all that stuff like helps with that. So it's not really sexy, but it's kind of just the blocking and tackling basics of it is how do you get your message out? How do people know you? How do people know what you're doing and why they should know, like, and trust you? Because they don't know, like, and trust you, they're not going to give you $1.
Yeah. Yeah. Gotcha. Awesome. It's been as we were talking about probably a few different times. It's been more challenging on the operation side. Is there anything the past few years that you guys have changed or kind of optimized or try to really ratchet down on in terms of just operations and just trying to get ahead of the curve? It's been pretty challenging. We were just talking about before before we started the pod or this webinar and all that, how in Houston it's been actually pretty decent from a concession standpoint, but the last 2 months, I guess with holidays and all that, it's always tough around the holidays anyways, but it's been a bear the last month or so. But anyways, yeah, I would love to hear what you guys are kind of doing on the operation side.
Yeah, I mean, on the revenue, every deal is a little different. So, some we're having to like surge marketing and, go way over budget because we're just not getting traffic and try different marketing sources, because every property is a little different. Every sub-market's a little different. So sometimes a pay-per-click Google makes sense. Sometimes apartments.com makes sense. Sometimes it's, whatever, locator market, so being specific to the sub-market and the asset. And, if it's not working, try something different until you kind of figure out what's working. So, big focus recently has been kind of tracking lead sources and like what's the source of lead, making sure we're getting bang for the buck on the marketing. Taking a step back kind of everything was, well, I grew up in the normal pre-COVID, and the market was, up and to the right, and it was, we had ebbs and flows and seasonality and stuff like that, but it wasn't dramatic swings. It was kind of, gradual increase. And then COVID, everything went dark and then exploded, and then it's been bad for, the peak of rents is probably year in 22 is probably peak of rent. So, we're kind of 3 years in a declining rental rate environment in general, broadly speaking, right? Um, and during COVID, we got, 2021, we got, somewhere depending on the deal in the submarket, 15 to 20% rent growth in 1 year when we're normally looking for three. So we got, 5 to 6 years of rent growth in 1 year. And doing that, everyone got a little loose and a little sloppy, especially with trying to make sure you retain talent. And so you weren't as focused on some of the bleed that was going on in your OpEx or R&M and things like that. So, as things get a little tighter, you just really like tighten up on your expenses and focus on, this turn costs. Are we replacing too many carpets? Should we be cleaning them versus replacing them? What are we just, getting loose on getting vendors out? The maintenance guys are getting lazy. They, instead of fixing this, they, call a third party in, and then your contract services go out, and, looking at your trash and rolling out bulk Wi-Fi. Where's your other income? You're properly billing back your rubs, you're leaving money on the table, you're doing capturing out 50% when you should be capturing 80 or 85% of the water bill, and they're just kind of really being diligent and audit it, and, just kind of just really rolling the sleeves up and getting granular property by property, and, trying to eke these dollars out. And a lot of this is just like a little momentum. What I've been kind of preaching internally, we're looking for progress, not perfection. And, we just need to make a little bit of progress, day in, day out, and that progress will compound itself. And, the market's been tough, and, the rents are kind of the rents, but, can we control collections, and, are we billing back the proper amount for utilities, and are we watching the spend on turns and things like that? Those are really kind of the focuses. And we're seeing some wins. Saw a win last year. Should see another win on insurance. Starting to see big wins on taxes. These taxes are going to really move the needle. The problem in Texas is slow and sticky, right? So slow on the way up and slow on the way down. So we're still fighting 24, and probably at least half our property is still fighting 24, and we're in 2026. So, for the next, over the next 6 months, generally speaking, we'll settle the 24 values, and then we'll get a big old refund. So, but by the time I get a big refund in the third or fourth quarter of 2026, my 2024 tax payment, my 25 and my 26 values are out. So it's just kind of like, you're looking in the rearview mirror. I saved 200,000 on this tax bill and a big refund, but I've had to pay that money in and give the county interest-free loan until I get my money back, after fighting and many, many months later. So, but the inverse is true. That's one thing I think I kind of really dawned on me a few months ago, Dustin, was like, when we were kind of running up from, 2013 through 2022 in my case, every deal that we bought, you had to say, okay, hey, the tax value's at, what, 20 million. I'm buying this thing for 30 million. Is on a tax rules for 20 million. Do I underwrite 80, 85, 90, 95% of tax of the purchase price and taxes on a kind of pro forma basis? And so say you get 90% taxes, the lender buys off on that, and then they give you a loan based off of NOI that includes 90% of the purchase price and taxes. Well, all these deals we're buying now or you're refinancing now, these tax numbers have caught up. So the values on the tax rolls are so high that, we're buying a deal at, 30 million bucks on tax rolls for 38 or 40. And so the lender's underwriting 100% of the purchase price, maybe inflated at 3% if you don't have the millage rate set. So it might be 103% of the purchase price and underwritten effective taxes,
pretty
right?
high level, but oh, okay. I'm trying to catch up.
Yep.
Okay.
So,
Yeah.
Hold
so
on. Oh yeah.
yeah, so that's really like a big deal where you start thinking about how these loan sizes, when you're underwriting 90% of the purchase price, it really gives you this extra juice in your leverage, gets you more loan amount, it makes your returns look a little bit better. When the inverse is true, if you're underwriting 13% higher in taxes, then it really has a dampening effect on the amount of money you can actually get from a lender. So, I think the flywheel will start spinning in a positive way once these values all kind of get reset. And then, as we look in 26 and 27 and 28, values recover, but the tax band's slow to kind of catch up. I think it's really kind of the gasoline on the fire. I didn't quite fully appreciate how impactful in a positive way that was when we were running up until a little bit of reflection, because that's just the way math works. So I think, the recovery, it's been pretty shitty for 3 years. And, everyone's got recency bias, myself included. But, there's going to be a backside of this, and rents are going to grow, and they'll grow a little quicker when there's not limited supply, and the inflation on all these expenses have is abated largely. So assuming that stays sort of benign, where revenue should outpace expenses, we'll get a big tax reset, and then we're going to kind of start growing from there. So I think there is a backside to all this, and those that can push through all the obstacles and do deals in 25, 26, 27, 24. I think all those vintage deals should age pretty well. We should all make a whole bunch of money, or at least that's what I'm telling myself to continue to go forward here.
Yeah, gotcha. Awesome. Well, I wanted to mention too, I just put a link to Michael to your newsletter in the chat. So we read it. It's pretty insightful. So I'd encourage you guys to check that out too. Before we kind of start wrapping stuff up, any questions, if you could feel free to throw them in the chat for Michael, or unmute yourself if you want to ask too. So, yeah, while we've got a few minutes left. If, yes, Eugene, did you have a question?
Yes. Hi guys, can you hear me well?
Yep. Yep.
Perfect. Thank you very much. I enjoyed the session a lot. Thank you. I'm a Canadian investor. I deal with multi-residential in Canada, and I expand my portfolio to Fort Worth, Texas. Michael, I would like to ask you a question. My portfolio is much smaller, much smaller. I'm looking for private lenders. I work with Canadians in some networking and groups. It's going pretty well, but it's going slow, obviously. It takes time that people knows you. What would you advise? Creative way to build a larger list of investors.
List investors. I mean, like I said, it's really, I don't know if there's any sort of magic pill, but it's about being, you got to people have to know that what you do and who you are.
Yeah.
You have to find a way to kind of be like a thought leader in the space, right? So was that a newsletter? Is that a podcast? Is that a meetup? Is that, whatever that is? And then kind of, got to be consistent. I see Aaron Katz here. So every time I see Aaron Katz, I think he does a good job of being real regular and consistent. He's had a meetup and he grew it to pretty big, and then kind of went away and started over and has got a new meetup and has grown it to be pretty big. And Aaron's been always really good about being very consistent and regular and having that. And that's been, I'm sure, a large part of his success in raising capital is from his consistency of following through and being very on brand and on topic, and kind of flying his own flag, because no one knows what you do, then no one can give you money. So whatever version of that is, and then I think from there it's about asking for referrals and who those people know that you should know, and it'll just kind of compound. And it starts a little slow, and then so over time, especially if you can do a deal and successfully exit for a profit, and a few years later, that's the best thing, right? There's lots of ways to communicate, and the best way to communicate is with the check. So if you give you a dollar and you give them back two, they tend to like you pretty well. Or in probably all our cases on this thing, if you give me a dollar and give back three or three and a half in a 2 year period, like you did in the mid teens, they really like you, and you can really grow pretty quick. So I don't really have a magic answer besides just like the day in, the day out, and it probably feels really slow to start, but then you kind of look back in 5 or 10 year period to see how large it has grown. Because if you would have met me in 2013 to see kind of where we are now, I had no idea that we could have done got 2.5–3 billion dollars in real estate or whatever we've done. I mean, it's just a staggering number, to kind of look at. Earlier this year we bought a $110 million deal. I mean, with over 50 million in equity, I mean, it's like wow to think those are, just those numbers just don't even compute in my brain in a lot of ways. And it's just, it's just another
Same here.
deal.
Yeah, got it. I see. Thank you very much.
Yep.
Hayden, did you have something?
Yeah, it looks like we got another one from Will. Will asked, does SPI have internships available?
Internships, we do not have internships. So we probably should, but we're so small, we haven't ever done one of those. But that's a good idea. If you're young trying to do it, I would encourage brokerage firms, like, some of the apartment realtors essentially, or mortgage companies, that are, the financing these deals. Those are be two great places trying to get into either through the sales process or that. I mean, a lot of these bigger companies have like kind of training programs, and you go kind of a little extreme and get like Marcus and Millichap, where it's like, go through the program and here's a phone book and a chair and a cubicle and a phone and start dialing and eat what you kill type of thing. That'd be a great way to learn the business, I am sure. Or I came in through the lending side, which was also a great way of. You see a lot of opportunity in pitches, so I would think being a service provider on either the debt or the sales side would probably be two pretty good ways, or potentially at a development firm. But I don't know that much about development because we don't do development.
Awesome. Yeah, I'd be curious too, just kind of going back to strategy really over the last few years, how it's changed, um, and what you might change moving forward, but especially given a value add, right? Because when rents are going backwards on you, your value add strategy probably looks very different from when you're in a rising rent environment. So, how has your value add strategy changed maybe over the last few years? And
Yeah.
then, like you said, as the supply falls off, that could drive rents, and that value add strategy might look a little bit more attractive
Yeah.
again. So,
Hasn't made any sense for a few years to do any value add. So, we're not doing any value add in large scale at least, right? So what I think we're focused on, Hayden, is like the agency we bought was the guy, he had put, $6 million the prior 3 to 4 years that he had owned it. He put 6 million in capital. So he bought the deal that was kind of classic. He did the office, he did the pool, he did full exterior carpentry paint, dog park, all the amenities. And he went through, he had two different finishing levels. So about a quarter of the units were done at the top tier, and about 95% of the units were renovated. So the balance were kind of like the mid tier, which, stainless versus black appliances are the main difference, and countertops being sprayed versus quartz or granite countertops. So he had already gone through and renovated all these units. So my capital risk is much less. So I just thought the basis was such that we're in it way below all my competitors that kind of own properties around us. I really don't have to spend a lot of money to upgrade it. I just kind of we had some accrued deferred maintenance that kind of we had to do a boiler and some parking lot. And trim the trees in 4 years, and we had a little bit of roof work, and then we budgeted for a paint job because the paint job was about 4 years old. And we knew during the hold period, year three, give or take, we need to paint the building. So we capitalized that up front to make sure we had funds to paint it. But it was really just kind of like buy it. I have the better product than most of my comps. I have a lower basis, so I can, effectively get my economics or such that I can take lower rents and still be profitable and wait for all my competitors to trade. So that submarket, to be very specific, that submarket has four deals that need to trade before the submarket can recover. It's in the Hewlin submarket. So there's a deal on the market called Tides on Hewlin. There's a deal called The Hub, which is the same seller that we bought ours from. There's my old deal I used to own called Park at LeBlanc. And then there's a deal called Barcelona, and then kind of a fifth deal called Milo. And so as of, I think, this week, Tides and the Hub deal are both going to get into escrow. Same buyer, pretty well-heeled Dallas group are going to buy it. Both the Tides will be less per door than us, but Tides is all messed up because it was a Tides deal. And then the other deal, which is by the same seller, is going to be about 15 a door higher than what I paid, from what I'm being told. A little bigger units, the rents are slightly higher, but pretty similar product. So those two will trade. I heard Barcelona's going out at an NMHC, and whatever the hell the other one, the Park of LeBlanc, Will Hubbard's about to bring that out as well. I don't know if that one trades because it's not worth his debt, so it's got to gonna have a little journey to see how that one goes. But if all four of those can kind of get resolved in some form or fashion in 2026, the submarket kind of gets reset and then it'll go. If those deals kind of linger, it's gonna take a little longer for the submarket to kind of get reset. So I was kind of thinking like I knew all, so I went through every property and toured every property and understood what the situation was with all those deals and kind of what's the likelihood of them trading and so forth and so on. And so those are things I was thinking about when I was looking at the sub market. And all those are the hub is kind of comparable. The others are all physically inferior to my asset. They need to be renovated. So someone's going to buy it and then have to put 10 or 15 a door into it to then get it up to the level that I'm at. So I really like my position better than their position. So that kind of made more sense because the value add is kind of dead. And so it's just really like you got to buy a good basis of weight. And then the market will improve. And then my renovations will be, instead of 3 years old, they'll be, 5, 6, 7 years old when the market is ready, and then we'll just do the next version of the upgrade, and I'll sell it. The next guy will come in and redo whatever the current design of the day is.
Yeah, and I know that your deal really well. I grew up over there and live not too far from there, and I drive by it all the time. But yeah, and I like your locations a little bit better.
Yep.
Your retail across the streets a little bit better. You got, I think Panda Express, and
We
I
sit on
can,
Hewland. The others are kind of back tucked in a cluster
yeah,
of apartments.
yeah,
Kind of off the main drag.
yeah, and they're next. They have that railroad track right behind them too, and so and that retail right there is weaker than kind of what's next to you too. So, anyways, yeah, I think that'll end up being a super good buy, or
Let's
good
hope.
buy for you. So, yeah, yeah,
They all seem like good ideas when you do them. So time will tell.
yeah, yeah, exactly. Any other questions before we kind of wrap up for Michael? Well, cool. Yeah,
Um,
is oh,
Real
go
quick,
ahead.
we Avinash did ask if there's a way to get maybe a one-on-one conversation or get in touch with you. I don't know if you have any places you want to direct people, Michael.
Yeah, I mean, just go to the website. There's a form you can fill out. Make sure you get in the database first and foremost, and get on um, the quarterly newsletter and kind of see what we're doing. I think that'd be the first thing. And if you want to reach out to the website, I kind of mentioned that you're on the webinar with Momentum, and I'll carve out 15 minutes, not too distant future, and do a phone call.
Awesome. Well, sounds great. We'll appreciate your time, Michael,
Yep,
and yeah, hope to see you out at NMHC, and we'll talk soon.
I appreciate it, guys. Thanks.
Yeah, take
Thanks,
care. See
guys.
you guys. Thank you, everyone.
Thank you so
See you
much.
guys.
Yeah.
Bye.